Hey, MCE crew. I know that some people feel as though some of the information we give here is doom and gloom. It's not, it's just factual. Okay. Now, I want you to hear, because hearing it from me is one thing. Sure, I own a financial services company, but I'm no JP Morgan. I readily admit that. Okay. They've got $3 trillion on their balance sheet. They're one of the largest banks in America, in the world. Say what you will about them, they know what they're talking about. So I want you to hear from their CEO, Jamie Dimon, as he explains his view on what's coming in our economy. We're going to dig into this because this guy has a lot to say in this clip.
Look, I'm an optimist. I said there's storm clouds, they're big storm clouds, it's a hurricane. Right now it's kind of sunny, things are doing fine. Everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy Sandy or Andrew or something like that. And you better brace yourself. So JP Morgan is bracing ourselves, and we're going to be very conservative in our balance sheet on with all this capital uncertainty. We're going to have to take actions, and I kind of want to shed non-operating deposits again, which we can do in size, to protect ourselves so we can serve clients in bad times. And so that's the environment we're dealing with. And I think it's okay to hope that'll end up okay. I hope it. That's my Goldilocks. I hope. Who the hell knows?
Okay, guys, let's chop some of this up. All right, now, first of all, you see how he ended that off? Who the hell knows? When the CEO of a major global bank with $3 trillion on their balance sheet expresses that type of exasperation, it means that we're in uncharted territory, okay? We're in big time uncharted territory. And that is why I'm a big advocate for falling back on those fundamental financial principles that have stood the test of time, like buy low, sell high, pay off debt to the extent that you can, especially that high interest credit card debt. You're going to need some flexibility, and you're going to need some cash flow where we're going. You're also going to need, and part of the reason why you're going to need that cash flow is because you're going to need to be able to seize opportunities, because a lot of assets are going to, and already have, and will continue to become less expensive and much more affordable. These are the times, and we did a video on this a long time ago before we moved up to the current level of production value. But we did a video talking about how it was one of the Rothschilds. Now, if you know the Rothschilds, they know whatever else is true about them, they know money. Okay, that family has existed in the financial services industry for literally centuries. Okay, so they know what they're talking about. And one of the Rothschilds said, the time to make money, I'm paraphrasing here, but here's the quote, is when there's blood in the streets. Now, what he meant by that is when there is chaos out there. And he literally meant blood, because he's talking about revolutions, wars, recessions as well, bear markets. These are the times when you can prosper. Now, you're not going to buy something low today and then have it just all of a sudden run up 15% tomorrow. It's going to take time, okay? Again, I'm not a trader. There are plenty of trading channels out there on YouTube where you can get that type of advice if that's what you want to endeavor in. I'm a long-term investor. I want to see my assets appreciate and provide income, okay? I'm not into the high-frequency trade thing. So the other thing that Dimon mentioned, and he was very specific about this, he said that they can shed non-operating deposits. What does that mean? Well, first you got to understand that when you deposit money into a bank and they hold it there for you in a savings account or in a certificate of deposit, that is a liability for them. It's not an asset for them. It's a liability in that you can come into that bank at any time and request all of the money you have. That's why in a CD, there's certain, penalties if you do the early withdrawal thing. If you go into the bank right now and you've got $10,000 in that bank and you say, I want to withdraw $9,900 from my savings account, watch how they act, okay? It's not going to be an instant transaction, and you'll probably get the attention of the bank manager, okay? It's going to take a while because you basically are taking away their ability to put money into play to lend. On your $10,000, let's just say you have a 10-to-1 on the, they call it the, what's the term? Fractional reserve lending. So let's just say you have 10-to-1. That means that if you deposit $10,000 in the bank, it gives the bank the ability to lend out $100,000. They can literally create money. The government allows them to do that. Okay. The Fed specifically has that arrangement with them. So if you take out your $10,000, you are taking away from them the ability to lend out 10 times that. They're going to have an issue with that. Okay. But what DImon is saying is, to the extent that we're going into this new territory where lending actually might slow down a little bit, can you imagine a bank calling you up and saying, come get your money? We don't want this liability on our books right now, so come and get your money. Or go into a negative interest type of environment where it actually costs you to keep money in the bank because they don't want your money. Right now, you're almost at that point. You're so far under the level of inflation, either number, the 8.5% or the 15%, real inflation, 15%, which includes food and energy. Your savings products are so far under that in terms of the interest that they're getting, it doesn't make any sense to keep money in a bank, okay, in a savings or a certificate of deposit, any of those savings products. Sure, you need money in a bank to transact bills and things like that. That's why, me personally, I don't keep any more money in a bank than it would take to, pay bills and do those automatic bill pay things. Now, let's talk about another financial institution where you're more of a partner in the equation than you are as a depositor in a bank. An insurance company takes your money that you pay in premiums and it invests that money. And so it sets up a scenario whereby you can get a better return off of a permanent, properly structured, permanent life insurance policy than you would ever be able to get at a bank. Okay. Now, there are also all kinds of incentives that come with choosing an insurance company as your financial institution where you're going to keep some of that money. All right. The bank still has its purpose. If you need a loan to propel your business, the bank's the place to go, okay, to get that loan. Sure, they're going to want to see you with some money on deposit. Okay, if you want a business credit card, a lot of these small banks are going to say, well, you need to have some money in here with us. You need to have some stake in the game here. Okay. So yeah, if you want a loan to propel, you to be able to do other things in your business, or you want a mortgage, bank is a good option. Also, if you want to take advantage of fractional lending, excuse me, if you want to take advantage of fractional lending, you say, how can I get on this thing where someone puts in $100 and it gives the bank the ability to lend $1,000? How do I get in on that? You can do your due diligence and figure out a bank to invest in, to buy shares from, a publicly traded bank. Okay. Now, let me give you another little nuance. Banks are governed by the Federal Reserve, the Federal Reserve Bank. Jerome Powell, Fed chair. The credit unions are governed a little different. So if you want to keep money in a scenario whereby You have less control by the Fed. And let me tell you why I'm talking about that. We're going to bring it all home here in a second. Because when you look at these banks and the ability to bail in, not bail out, where the government comes and gives them money, remember what I said a few moments ago. Your deposits are liabilities. And if a company gets in trouble, then there are several mechanisms in America where you can shed liabilities. And if a bank sheds liabilities, then that means your deposits are at risk. Now you might say, well, what about the FDIC? Sure. You got $250,000, you're insured up to that amount with the Federal Deposit Insurance Company. But I want you to keep this in mind. If you look at the rules that govern that system, they don't have to make you whole immediately. They've got all kinds of actuarial tables that give them the rights to, piecemeal you, especially depending on your age. Someone older is going to be made whole sooner because they presumably have less time on the earth than someone younger. Okay. So if I've got, money, I want to keep it in a situation where I'm more of a partner. And that partnership is at the financial institution that you rarely think about. You think about banks all the time because you pass them several times a day. They're on every corner. But you don't think about insurance companies. When people think of insurance companies, they usually think of loss. Well, if I die or if the car gets into an accident, everything will be made whole. But when we talk about properly structured permanent life insurance, you have to remember that it's really got more benefits here in the here and now than it does in the hereafter for you and your family. Okay, especially when you consider tax benefits. You're able to accumulate money and have it grow tax-free. You're able to access it tax-free if you do it correctly as a loan, and you're able to pass that money on and make it into generational wealth, legacy wealth, unencumbered by taxation. Okay, so we had that discussion, and then there are the brokerage companies. That's another financial institution you could put money with when you could invest in a publicly traded company. Jamie Dimon, who we heard from, CEO of JP Morgan, he's telling you that the waters are getting rough, and not even he with trillions of dollars. Think about the resources that this man and this bank has access to. Okay, when there's something going on in the world of finance, the president calls people like Jamie Dimon. All right. And he has told you that, hey, look, a lot of this, I don't even know what's going to happen. That's a very honest answer. But if you are in a situation where you have assets, okay, hard assets, paper assets. What are paper assets? Well, what are hard assets? Real estate, gold, silver. What are paper assets? Stocks, bonds, insurance policies. Now, all of this stuff, you've got to do your due diligence on. I'm not giving you personal financial advice. And then let me close this out the way I always do. Well, not always, but sometimes do. The asset that has the highest revenue and profit potential is your own business, a business that you own and you manage. Okay. We've done a lot of talk around that. If you go to the community page, we've got our webinar coming up on the 15th that's going to go over legacy wealth, and we'll have some discussion about having your own business in there as well, because that's something you can also pass on to your heirs as an aspect of legacy wealth. So go to the community page, scroll down to register for that if you're so inclined. There is no monetary cost. There is a temporal cost, an hour of your time. Okay, so that's what we've got going on. All right, today I want you to seriously think about these things, because if this guy who's the captain of a really, really big ship is saying that he's got the binoculars and he's looking and he's seeing a bunch of storm clouds, okay, out there on the horizon, you heard him use the term hurricane. And he was very adamant when he used that term.
It's a hurricane.
Okay. So take it for what it's worth. Guys, I'll talk to you soon.